Hello everyone, my name is Mattea Crawford,
And I'm Eileen.
and we are Company G, otherwise known as DG. Over the last 10 years, our company has stumbled across many obstacles and opportunities. We started simulation as a top 3 contender in the camera industry, but sadly we fell to the bottom by the end of the year, or by the final year. And I have to say it's pretty devastating, and we're actually disappointed in it, but we learned a lot throughout the simulation. And throughout this presentation, we're going to cover the decisions made behind the monumental numbers. Our vision statement remained the same throughout the entire simulation. We wanted to be the company that consumers went to for the highest quality camera at an affordable price. That's why our vision statement is to provide customers with exceptional and innovative, effectively advanced cameras at an affordable price to capture all of life's moments.
Now, with our vision statement in mind, our strategies for the entry-level and multi-feature cameras were very comparable to one another. We began our entry-level cameras with a low-cost leadership strategy. And after much analysis, we figured that our strategy was leaning more towards the global differentiation strategy. And so we did kind of change it up a bit. And it was because we wanted to give customers a high-quality camera at a low and affordable price. And we do this by pricing our cameras at an industry average or below average rate and offering discounts and promotions throughout the year for our cameras. Now, as you can see here, our image rating has only increased tremendously from where we started. We started at below the investor expectation, and we did rise up to about a 92 by the end of our last year. There has only been a few years where we did have a few fallbacks, but nonetheless, our image rating has consistently improved. Throughout the simulation, one of our main goals was to continuously increase and improve our image rating, and I think we did quite a good job. We increased our image rating by producing cameras with a PQ rating of a 2 or higher, and for both the entry-level and multi-feature cameras. And we also attempt at increasing our social responsibility budget yearly. So we are pretty happy that we ended up with a 92. It's the highest image rating we've had in a decade, so we're pretty good about that.
Okay. Similar to the image rating graph shown on the previous slide that Mike talked about, our net revenue continued to grow at a steadily constant rate, with the exception of years 6 and 11. So at 6 and 11, we were kind of stagnant. We stayed either similar to the previous year or we dropped just slightly. We noticed that through years 7 through 9, our company did not see many changes or generate more revenue coming in, and that's because with our strategy, we pretty much stuck with the same thing as the previous year and just made minor adjustments without making anything significant changes to our strategy. So because of that, we felt secure and comfortable with making those small changes, and we didn't really see any big changes in our results. Finally, in year 10, where we made our biggest jump right here, we increased our technical service, and I feel like that's why we generated more results.
Now, moving on to the credit rating, our company has strived to have a credit rating of a B+ or higher, similar to what the investor expectations are of us. Throughout the simulation, we focused a portion of our resources to pay our loans when we need to. Especially what we did was during the fourth quarter of the year, when we get an overview or an estimate of the cash we will have on hand, we kind of pay a portion of the loan outstanding during that quarter, just so we don't have a bad credit rating. But we also worked at issuing stocks when our finance seems to be falling short, and to repurchase stocks when we started getting a little bit more in revenue and profit. Now, as you can see in year 15, one of the mistakes that was made during that year was we did regrettably repurchase some stocks that should not have been purchased. We didn't, well, I guess I didn't. I wasn't able to go back and check my work, and so our credit rating did drop and our debt increased by more than 180%, which was pretty bad, but it's over now.
Now onto the downs of our company, the earnings per share. As you can see from the graph, we started out strong, but as of our ending year, our EPS was pretty much a failure. You see in year 15, we dropped all the way down to almost negative 12%. It was mainly just the fact that we were losing a lot of money on our entry-level cameras sold. And while that was happening, we were also repurchasing back stocks. This was a mistake that we shouldn't have been doing.
You know, same as what Mateo was saying, our return on equity was the same. Even when we started, we constantly went downhill, but in year 10, we did see a slight increase, actually a really big jump, which was really good, but it did go down again. We tried everything we could, by repurchasing stocks and even increasing dividends to help in this factor, but nothing really worked. And I think a lot of the reason why they didn't work was because of our operating profit, especially when the market for cameras started to decline. We did see a shift in our operating profit, and it began to decrease and fell down into the negatives.
And in regards to our stock prices, they were constantly fluctuating. They never seemed to be higher than what the investors were expecting, and they never really experienced a whole lot of growth. What we tried to do was repurchase stocks as much as we could, but it was a lot tougher said than done. Our company also wanted to offer a high and competitive dividend for our shareholders.
Now, before we end this presentation, we just kind of wanted to go over some lessons that we did learn throughout the simulation. And one of them is that the reports that the simulation generates after a year ends, that report holds a lot of the answers and a lot of the reason why you did something wrong or why you are in the place that you're in. And it is the only way to be in the lead. The only way to be in the lead is to just have a full understanding of what you did differently than your competitors and the rest of the companies. Towards the end of the simulation, we were just very focused on distributing more products and gaining high demand, that we did not spend enough resource on the financial aspect of our company, and that's kind of why we fell a little bit short on our finance-wise, such as the ROE, and what was the other one? The ROE and the earnings per share.
Yeah.
And second, it's just to experiment. We were afraid to take risk and to, of like a failing and just dropping down in the numbers. Our company had a tough time about that. We always felt comfortable in where we were. Like Mateo was saying earlier, we just made minor changes. We didn't really do a lot of experimentation on which one would work better than the other. Thirdly, to just double check your work. I've made that mistake many times, and it really did cost us our place and how our company was run. So just double check your work and make sure that you're happy in the work that you've done. Also, lastly, it's just to have fun with the simulation. I think for me and Mattia, we were just so focused on doing better than our competitors that we forgot to enjoy it and just to have fun with it. And so I think if we did that, we would have had a better time and we would have been a little bit higher. But in closing, we want to leave you guys with a quote that we hold close to our company. It is from Henry Ford, and as you guys all may know, he is the founder of Ford, and he says that failure is simply the opportunity to begin again, this time more intelligently. So this time when we come back, we're going to knock it out of the park, yes, and come back strong.
Yep.
Thank you.
Thank you.